Hello, everyone. My name is Alexandra Shepis, and I'm a Senior Associate Advisor here at Francis Financial. Welcome to our December Investment Insights. Today, I'll be sharing some market trends that are impacting your portfolio and investing strategies on how to continue to grow and protect your wealth. So with that, let's go ahead and jump right in, starting with returns across different asset classes for November. With this chart, the dark teal represents the November returns, light teal is year to date, and the gray color is 3-year annualized returns. Right off the bat, we can see that U.S. large company growth stocks are down about 23% year to date, compared to U.S. value stocks, which performed much better and are down only about 4% year to date. Now, if we look specifically at November was a strong month for performance across various asset classes. Again, we see that U.S. value stocks were stronger than growth stocks. International developed stocks, they had a very strong month. They were up over 11% for the month as investors focused on slowing inflation, strong inventory levels of natural gas, and investors grew increasingly convinced of a recovery starting in Europe during 2023. Emerging markets were up even stronger. They were up over 13% for the month. At the top of the chart, we have a diversified portfolio, which is about 60% stocks, 40% in bonds. Zooming out to the 3-year mark for that longer term investment horizon, we see that a diversified portfolio returned about 4%. Now let's review some inflation data. The CPI was down for its 5th consecutive monthly decline at 7.1%. The core consumer price index there on the bottom, this actually removes CPI pieces that can exhibit large amounts of volatility from month to month. That was at 6%, back to the level from the beginning of the year. November had continued positive results with price declines in areas such as gasoline, utilities, and medical care. Housing costs remain elevated through long-term leases, but rents are starting to decline, so future reports should start to show housing moderating. The Fed met for its December meeting, and during its meeting, Chairman Powell noted the labor market is the real issue at this point, and the Fed needs to see loosening of labor market conditions. Unemployment is still incredibly low for the Fed. Right now, we're seeing there are about 2 jobs available for every 1 person looking. So it's important to note that about 55% of the CPI is attributable to labor costs. At the December meeting, the Fed raised rates another 0.5% or 50 basis points, and the Fed funds rate is now 4.25 to 4.5%. Looking ahead, we do expect an interest rate increase of another 0.25% at the February meeting. Speaking of the Fed, there were a lot of eyes and ears on the December meeting. We have here the Fed's dot plot from December. The Fed produces this chart 4 times per year. Each dot that you see represents the Fed's rate-setting committee members and where they think the Fed funds rate will be for future years. So as we're at the end of 2022, we see the Fed members are all at 4.25%. In 2023, 17 of the 19 members, so a large majority, expect rates to go above 5%. This is interesting because in the September dot chart, none of the members had rates going above 5%. So we are seeing that trend upwards. We expect another interest rate increase at the February meeting, and expect rates will be higher for longer than investors were originally anticipating. During the meeting, Fed Chairman Powell, he reiterated that the 2% target for inflation will not be changed. Markets are starting to accept this as stocks were up sharply with the lower inflation data, but then traded off after the Fed remarks. Switching gears a little bit, let's talk about real estate. So existing home sales fell 5.9% for the month and are down over 30% since January. The slowdown in housing is continuing on and may be a sign of things to come in the overall economy, which we would expect to be reflected in 2023. Talks about a potential recession in 2023 are circulating. The impact of higher interest rates is often first seen in the housing market, which is quite sensitive to changes in the rates, as home purchases are usually financed via mortgage. If a recession occurs, we estimate it will be a mild recession, and it will lead to the Fed reversing its course, which could lead to a strong stock market rally. Investors during November became increasingly optimistic about the potential for a soft landing, avoiding recession altogether. And when we say soft landing, what we're referring to is an effort on the part of the Fed to slow the economy and bring down inflation while preventing the US from entering a recession. A few important takeaways. Markets are forward-looking and tend to move very quickly. We saw that in the strong November returns. The moderate change in the outlook for Europe led to a double-digit recovery in just 1 month. It's important to stay fully invested and don't try to time the market. And keep in mind that your portfolio is not the S&P 500 or the NASDAQ. It is a well-diversified portfolio that is designed to smooth the ups and downs of the market over time. So as always, please reach out to us if you have any questions. All of us here at Francis Financial are wishing you a very happy holiday season, and we will see you in the new year. Thank you.